Hi, my name is Ruben Mann, and today we're going to be talking about putting together an MREA profit and loss statement and also how MREA accounting varies from tax return accounting. And there's some significant differences. So first off, for most agents around the country, the cost of goods sold line item on their MREA chart of accounts does not have tax implications. That's huge because that means it does not actually show up on your tax return, but it is something that you're trying to see on your profit and loss statement. So it just highlights how there's some major differences. And here's sort of how it all goes. So your profit and loss statement is comprised of three parts. You have your income, you have your cost of goods sold, and you have your expenses. Your income in the MREA chart of accounts is going to be the total amount of money generated by your business. So this is going to include the cap that you ultimately pay to Keller Williams. It's going to include all of the fees that go to buyer's agents and listing agents and referral fees, all sorts of things that are actually paid by Keller Williams but out of money generated by your business. So while your business may generate, let's say, $10,000 on a deal, but if you give $5,000 to a buyer's agent, your business only gets a check for $5,000. Your buyer's agent just happens to get a check for $5,000 as well. So the full $10,000 needs to be reflected on the profit and loss statement, but on your tax return, you're only getting a 1099 for the $5,000 that you actually received. So your tax return, really the income doesn't start until cost of goods are eliminated. And of course, it's never that simple. There's always one or two items, and this is client specific that are going to be included in cost of goods sold and actually do have tax implications. You just need to know what they are. So back to what a profit and loss statement, the three parts of it for the MREA chart of accounts. You have your top is your income. So again, this is coming off your disbursement authorization or your commission statement, but it's showing the gross commission generated by your business for that deal. Then you're going to have cost of goods sold. These are also coming off your disbursement authorizations or your commission statements, because what that shows us is how much money went to your buyer's agent, how much went to the office, how much went to a referral, and all of the other places that money might have gone. So all of those things are going to be entered in cost of goods sold because they're based on a deal happening. It's based on a transaction. Cost of goods sold are transactions or expenses, that are only incurred if the transaction happens. So basically on your P&L, when you get to your net profit, or gross profit after that, your income minus your cost of goods sold, that should be very close to your 1099 and you should be able to reconcile your 1099 on your tax return to that number. So on your tax return, you're not using the income shown on the profit and loss statement, and you're not including the cost of goods sold. All you're starting at when you get to expenses. Because the expenses on your profit and loss statement are straight off your bank and credit card statements. So these are when you, the person on the front lines, has gone to a store and swiped your card, or your assistant, whomever, and bought something on behalf of the business. So all of those expenses are being cataloged on your bank and credit card statements. We're taking that information and putting it on your P&L. So your P&L then becomes just your disbursement authorizations and your bank and credit card statements, and reorganized into a format that you can use and that sort of is the same for all agents, so you can do a comparison, have masterminds, so on and so forth. And it's really that simple, at least when you've been doing it for a long time and that's sort of how your head orients. But it's something that you can all learn, and once you sort of get the bigger picture of what's going on that document, then you can really start to learn the story it's telling you, and ultimately in that story are the clues of how you can be more efficient, make more money, both gross revenue and money that you put in your pocket. And at the end of the day, that's what it's all about. I want to see all of my clients put the most money possible in their pocket. And your P&L can get you there. So anyway, that's a 5-minute overview of the MREA versus tax bookkeeping and sort of what's going on. And as always, if you have specific questions, feel free to contact us at Tax In-House. Have a great day. My name's Ruben Mann, and I will talk to you soon. Take care.